The fundraising market has been extremely difficult, as we know, in the last few years for all the reasons that we're familiar with and some that we discussed. And one of the market's distinguishing features has been the concentration of capital. So with 2023 marking a year where the 25 most successful fundraisers collected 41% of the capital. And given this added strain on fundraising operations, even for larger managers outside the top 25, many face significant challenges. The pressure is more pronounced amongst the mid-sized, small, emerging managers and even long-tenured managers who are large, but not mega. And Preqin noted that a similar trend of capital concentration in the hedge fund industry towards following the financial crisis, which led to the rise of the multi-manager or multi-strategy model, exemplified by Millennium and Citadel. So they employ semi-autonomous pods of star portfolio managers, while the central organization manages compliance, risk, and capital raising. So in this context, and this question is for Michael and Lee specifically, but others can certainly weigh in. Do you see this model emerging in the private equity arena? And if so, what private equity-oriented version, what might it look like? What factors are influencing this shift? And if not, what are the reasons behind the differences? So starting with Michael.
Sure. So having worked at several large institutions, I've kind of seen this play firsthand, and Moran itself kind of functions in a similar fashion, right? I manage a very specific strategy that acts as the kind of global venture growth strategy for the broader organization. And I think when you're thinking about kind of large scale investing, it's kind of a tale of two cities where you have to have some type of brand recognition or resources in order to get into, especially on the private side, super competitive deals. If the old adage, your fund size is your strategy, is really true, if I had a fund size a tenth of the size, I would be scouring the blocks right now, just running around looking for founders probably before they even came up with their idea, because that would be the most effective way for me to generate returns. And that's something that somebody in my seat that has to write a larger check just doesn't have the time or capacity to do. So as we start to have concentrated pools of capital, and we already talked about, going towards retail investing, that's because the top kind of family offices or institutions are allotted for, right? They already have a GP or LP problem on who they're allotting capital to. So now you're starting to go retail, and that's who would typically go towards a smaller GP. So I would think that this would continue to play out, and these larger organizations will just figure out ways to create fund sizes that make sense for whatever strategy they want to deploy, and then hire people to build out those teams internally.
Okay, Lee?
Sure. For fundraising, fundraising is always hard. Good periods, bad periods. It's highly competitive, and it's never easy to secure that next commitment from a client. That said, the stat around concentration here in 2023. Over the years, through cycles, you clearly see that in times of risk off, that the willingness of investors to pursue a smaller fund, an emerging manager, or what have you, is clearly less likely. And so consequently, it does drive capital concentration toward the more branded names out there, the more institutional platforms. And so consequently, you're going to see that dynamic. And I would expect that will begin to wane as the markets begin to settle out here in the back half of this year, post-election, and into next year. That said, though, clearly the larger managers, Schroders Capital included, has a multi-strategy approach to private assets in particular. And within private equity, we're one platform with many strategies within our platform. And I think the key thing here is that there are several types of firms out there that are pursuing multi-manager. You have the large global asset managers like a Schroders Capital that has a large traditional business, but sees the growth opportunity within private markets and clearly is making a very strong strategic commitment to that segment and making a huge investment to succeed there. And that's borne out with great success over the years. You have the private equity manager who's grown successfully and established a national global brand saying, hey, let's leverage this brand for other strategies. And you see them adding strategies, typically direct investment oriented, but also coming into the markets of a BlackRock or ourselves and trying to do things like secondaries and what have you, but looking to expand that brand into other strategies. And that's not going to stop. We mentioned in our first question the growth of private wealth. And I think, unfortunately, the growth in private wealth doesn't bode well for the smaller manager, to be honest with you. Regulation, scale, the size that you need to have to get on a platform to get access to capital really doesn't bode well to the smaller manager. And I think that's going to unfortunately play out both in good times and in bad times, because there's a real institutional barrier out there with many advisors to take on a smaller fund, just given the risk reward for their platform, because they don't have the resources to conduct a due diligence like a large endowment might be able to do, and so on and so forth. So I think the proliferation of multi-managers is going to continue. The concentration, particularly in private wealth, will definitely accentuate itself in the coming years. But that all said, there's plenty of opportunity. It's a very big, diverse marketplace out there for emerging managers to come out, innovate, be aggressive, and apply their skills to a specific strategy and generate unique return profiles for those managers those investors able to capitalize on that.
Yeah, I think if I could just add one thing quickly, I think there are two things. One is I think that the one major difference between the pod strategy and how it might play out in private equity markets is fundamentally the liquidity, right? Those managers can rebalance, they can rebalance across the pods. They can adjust to changing risk environments macro, which is very, very difficult to do with illiquid assets. So I think there will always be that fundamental difference. And the other question about kind of larger managers to smaller managers, I completely agree. I think the larger kind of private wealth will force a kind of structure that looks like kind of like in some ways a hub and spoke, where you have these kind of liquid or semi-liquid strategies played out into larger managers, and then you pick and choose where you want to add alpha with smaller, more focused strategies. That one is now, that kind of strategy can play out better when you have the technologies for these semi-liquid markets that have really come to pass in the last couple of years.